Good morning and welcome to today's webcast, Construction Audits, How to Manage Capital Program Construction Cost. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Mark Steranka, Partner, and Stephen Bachetti, Senior Manager. And with that, Mark, I'll turn it over to you to get us started.
Great, thanks so much, and thanks everyone for joining us. Good morning or afternoon, depending on your time zone. We had a great turnout for this webcast. Over 400 participants registered, as I mentioned, for all across the U.S. and really representing one of our largest sort of industry groups or client bases, which is our national tax exempt practice. So on the phone are representatives of state and local governments, tribes, a wide range of not-for-profits, and institutions of higher education, and those entities make up our one of our 9 industry groups for the firm. It's one of our leading industry groups in terms of service hours and number of clients. And so thank you so much for participating. We work with a lot of all of these types of entities in terms of construction audit services. So this webcast is really the second in a series of 3 webcasts, focusing first on internal audits and how to use that in terms of a comprehensive way to improve the performance of your organization. This one focusing on construction audits, which is really a key element of many of your organizations in terms of use of your capital, one of your primary assets of your organization, and a real opportunity for sort of financial improvement. And then the third in the series will be on contract audits, which again is a major sort of tool and resource utilized by many of our clients in how to audit and manage those as effectively as possible through audits. So today we're going to be talking about construction audits. I really have the pleasure, and I'm going to turn over the presentation to Stephen Bachetti. He leads the construction audit services for the firm, which is underneath the practice I lead. And I really consider Stephen to be one of the preeminent construction auditors in the Western U.S. We're able to really deliver very deep and broad value to our clients because we have very extensive construction experience, in coupling that with audit and accounting experience, really helping our clients to understand how they make their capital programs and construction contracts work as best as they can for them, how to make sure that they get, the highest potential value out of their projects and contractors as possible, and then making sure that their contractors are adhering to the contract terms, which is always kind of a delicate dance in the industry, and always an area for sort of fruitful gains in terms of our clients. So with that, I'm going to turn it over to Steve to talk about our construction advisory practice and our construction audit services. So over to you, Steve.
Thanks, Mark and Emily. Good morning, everyone. As Mark stated, my name is Steve Bachetti, and I'm a senior manager within our business consulting group leading our construction advisory team. I've navigated hundreds of construction audits, which have resulted in significant savings and control and performance improvements. Today, I will be sharing my knowledge and insight with you. So grab your cup of coffee or 3 and buckle your seatbelts. Overall, our group performs about 50 construction audits per year. Our major service lines include the contract reviews, the cost and control review, the change order reviews, the performance audits and program assessments. We also do policy and procedure work to support successful and consistent operations. And lately, we've been getting more and more involved with helping contractors seal up their contract language and or provide audit support to mitigate their audit exposures. Keep in mind, both sides of the transaction have concerns about being overcharged and having audit exposures. Our typical project ranges from $10 million to $5.5 billion. We have performed work on jobs as small as 1.5. We work directly with owners, developers, general contractors, construction managers on issues arising from schedule delays, construction quality, change orders, excessive charges, and project reporting. And our whole team this is what they do. They're skilled professionals, they're construction auditors, and we get a lot of experience, and we apply it to each of the jobs going forward. So today, we will be covering the contract types, the typical project team, common construction program exposures and cost implications, review areas, project risk identification and controls, which is a great slide, and key construction control focus areas, which is another great slide. We'll go over a case study and provide guidelines for what you can expect out of an audit and when to do it. And keep in mind, at the end of the presentation, there will be a Q&A session. Please, as we're going through this presentation, write and send any comments, questions, or concerns, and we'll address as many as we can during today's presentation. If we run out of time, you can either reach out directly to me or Mark, or I'll follow up with you guys via emails. And we have our first polling question. Emily, do you want to do the polling question?
All right. Our first polling question: do you currently have a capital construction program? And your options are yes, no, or not applicable. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. We'll give everyone a few moments. All right, let's go ahead and take a look at what everyone has to say. Back to you.
All right, great. So it looks like most of the people have it. Some of the people do not. So maybe you have something planned or in the works. And then for those that do not know, which is 10%, just look outside your window and see if you see any construction or cranes or anything going on. And that might help you decide whether you guys have some construction going on or not. Okay, so now we'll go through contract types and typical project team. The typical project team, some of this might not be new information to you, but I think it's good to quickly cover the different contract types and the typical project team so that we're all familiar with the basics. Contract types: lump sum, time and materials, cost plus, and the guaranteed maximum price. Each contract has a preferred project scope and type. Knowing when to utilize each contracting type can help you mitigate project risk and excessive charges. And the key to success, regardless of the contract, is ask for detail. So whatever the contract type, it's within your right and to ask for the detail to make sure that all the costs provided to you are fully supported. Okay, lump sum. The price includes fee and the cost of work. It assigns the majority of the risk to the contractor. And the risk on these contract types include higher markup, change orders, and quality of the materials. Keep in mind, typically you don't have audit rights on these contracts, so you don't have the invoice documentation to validate a lot of the things that are getting installed. These contract types are often utilized for cookie cutter jobs. For example, we had a Fortune 500 company who built many of the same buildings within a similar geographical location. They did a GMP contract first and then utilized lump sum contracts that were awarded via competitive bid process as they knew the approximate cost for each building. Next, we have the time and materials. The owner pays for the cost of work plus a set markup. The owner must establish the labor rates, material costs, and equipment rates prior to the contract. This is a common area where people fall into this common pitfall. Risks include no incentive for the contractor to manage costs, people not working as fast as they should, and it requires more supervision by the owner. These are typically performed for small projects that are fairly straightforward. For example, like a small paint job that needs to get done now. These jobs are typically labor intensive, and as stated before, having established rates up front can prevent excessive charges. So requesting documentation such as names, positions, dates, hours, rates, description of the work performed, and having someone on site managing that type of work is critical, so that when you get the monthly or weekly invoice, whatever the invoice cycle is, you can identify excessive labor rates or personnel that weren't actually working on the job. Cost plus, the owner pays for the cost of work plus the fee. Owner assumes risk for cost overruns. Similar to the T&M, the risk include no incentive for the contractor to manage costs, and more supervision is required by the owner. And finally, the guaranteed maximum price. Owner pays a specified allowable cost plus a fixed fee, typically fixed fee or fixed fee percentage. Contractor guarantees the project will be built within a predetermined amount. The contractor assumes risk for cost overruns unless they do a change order to you to recoup. And risk include poor contract language and cost compliance management. These are typically done on those jobs where they're unique enough where a lump sum competitive bid may leave money on the table. Contractors typically don't want to lock themselves into a contract given the unknown of a unique project, and you don't want to pay more than you have to. These contracts have the most opportunity for clarifications within the contract and or savings. All right, the construction project team. These are the typical faces you should see within your construction project or program. You have the construction department. You may also have a third-party project management supporting the overall program, whether it's a construction management firm or an owner rep. You have the architect, the general contractor, the subcontractors, and the auditor, whether it's internal or external. And by not having a healthy balance and or if the people don't have the experience in construction, you put yourself at risk of falling into common pitfalls where you may have excessive charges that were easily avoided, schedule delays due to bad procedures or inefficient procedures, reporting issues, or quality issues. And before we get into the meat of the presentation, I want to highlight that every person or organization attending this today has a different project size, different complexities for their project, staffing mixes, contract types, policy procedures, etc. So in the next few sections, I'll walk through the common project exposures and risk factors and review areas, which I think is a good subject matter for you guys. So as we go through this, keep in mind, most of these will apply to you. Some of them may not, but jot down any questions or concerns you have specific to your program, and I'll address as many as I can at the end. All right, so here's a list of common construction program exposures. As noted before, each program has a unique exposure. So someone, if you're doing a bunch of lump sum contracts, for the top one, you may not have issues with unfavorable contract terms. Take a look through the list and see what exposures most likely impact your program and project. And I'll go through a few just so you kind of understand. So let's do number one, which is my favorite as a construction auditor, unfavorable contract terms and controls. A common issue for projects are overruns and excessive charges are due to bad contract terms. If your contract language creates gray areas and they're not identified and addressed timely, hundreds of thousands of dollars or even millions of dollars can end up on the negotiation table or overlooked. For example, a common one we see is if your contract states actual labor charges are allowable. However, no limitations are specified within the contract. You could be getting charged excessive burden rates, labor rates, corporate personnel who are not on site at the project. For example, like indirect personnel like CFO or CEO, and or duplicate holiday, vacation, sick time charges. We'll get into this a little bit further in detail, but by not incorporating clear guidelines of allowable personnel, allowable rates, burden charges, and on-site, off-site requirements within the contract, by doing so, you can help mitigate risk of getting charged more than you should. This level of scrutiny needs to be applied on all the different cost types, just not labor, but I was using labor as a good example as it's a common area of excessive charges. Next, number two, which is another one of my favorites to discuss over a cup of coffee, inaccurate program financial records and reports. I often see where the facilities department may not be working directly with the accounting personnel, so the real project schedule may significantly differ from what accounting and the stakeholders and end users are expecting. And this issue can cause major operational disruptions and financial issues. For example, I've seen a client where they were not going to complete a facility that was going to house students on time. This information was not communicated upwards to operational and accounting and the leadership of the organization. So as the students were going to be going back to school, it caused operational chaos to figure out where they're going to house the kids to teach them. And another area I've also seen where master budget amounts were significantly different than the construction estimates, but only master budgets were being reported to key stakeholders, which created a unreported cash shortfall that needed to be addressed immediately. And finally, as we have plenty more to cover, but I'll just do another one, which is a very common one, overcharges and costly practices. I find at the end of the day, we all want to pay a reasonable price for a good product and not much more than that. Absent construction industry experience, you and your organization may fall victim to very avoidable costly practices. And I'll share another example with you. We recently had a project where our client had significant overruns during the design pre-construction phase of their project. Long story short, the design plans kept getting changed by senior management, and the project management team, who were consultants, the architect, and the pre-construction managers were going along for the ride. They never discussed cost impact, schedule impact as these decisions were being made. This was an easily avoidable practice. By having a good design plan that requires appropriate approvals for any owner-initiated changes with cost and schedule impact considerations. This issue, which cost millions of dollars, could have been avoided or significantly reduced. And other project risks that aren't included here, but some I'm sure your organizations have felt these pains, is sales and use tax compliance, state incentive and state credits and incentive opportunities, inefficient workflows, like if you build something out and operationally it doesn't make sense. So have you considered lean principles? For those that have taxable organizations, have you considered accelerating the depreciation? If you have this and you're not doing it, you're leaving money on the table. So there's a lot of program exposures that if you don't know what tools are available, you may be leaving money on the table. Okay, construction project risk factors. Here's a list of the project risk factors, or a common list of them. For example, the size of the project and the contract type can change the risk profile. That is, if you have a 100K job, it should carry a different risk profile than a 100 million job. If your program is utilizing lump sum contracts, procurement controls and change management and quality control are high risk areas. If your program has GMP contracts, both procurement, change management, quality, expenditure management are high risk areas. So knowing your project and the most appropriate contract type and addressing accordingly can help you mitigate the risk. Another area is owner construction experience. I find a lot of entities that we work with, construction is not their core set of skills. They have, it's a government or it's a university or hospital that they get funds, or they have a need to build out. So they have to get a team to support the operation. So the key is to select a qualified personnel and auditors that know the industry, that they can identify project risk and put together a tailored program to mitigate these risks. And we'll do a couple more. Project staffing. This applies to both internal and external. So does your program have too much or too little? If it's too little, then you may not be supporting a successful project. If it's too much, you may be incurring more charges than you need to. So I find developing and approving a yearly staffing plan for both internal and external staffing based off, let's say, construction activity for a project that's in the mix can help you improve overall operations and keep overall costs down. Risk factors, the exercise of the audit rights. If your contract does not have this, you should work with your contracting or legal department to get included within your contracts. I've seen the right to audit clause within GMP and lump sum contracts. So information is your friend. So the more, ask for detail. The more information you have, the better you are being able to make decisions. And another one, we'll do the funding source requirements and compliance requirements. A lot of organizations, they get bond funds that have certain requirements to ensure that their bond remains tax exempt, for example. So you got to know where the money's coming from. Is it for an allowable use? And if you don't know these requirements and you're spending money on non-compliant expenditures and your project goes over, you could be putting your organization at risk. And I'll do just one final one, which is, I think, a common thing that people are talking about now is contracting competition. Given the construction boom, obtaining qualified contractors at a reasonable price is getting more difficult. So ensuring the contractors have the capacity to do your project and ensuring that you're getting qualified people is critical. All right, moving on. This is the good stuff. Review areas, project risk identification and controls. and key construction control focus areas. And before we get into it, we have another polling question. Emily?
Okay, our second polling question. What is your capital programs or project's most significant risk? And your options are A, budget, B, schedule, C, scope or change orders, C, compliance, E, all of the above, or F, none of the above. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a couple more seconds here. And let's go ahead and take a look at the results. Steve, back to you.
Thank you, Emily. All right, let's take a look. So you got budget. Okay, that always confuses me. At the very bottom, it's the all of the above, which is the most common, and that's completely normal. Everyone's concerned about budget because you got to make sure you have enough money to pay for the project, and you don't want to pay more than you need to. Schedule can be critical depending on your organization and the needs of the facility. Scope changes. Everyone, I find when people get locked into projects, they feel like it's a never-ending change order game, which hopefully some of the material we go over today can help you with that. And compliance. And for those that have none of those concerns, which is 6.3% of you, great. Let's grab a cup of coffee after and let's talk about it. All right, so the review areas. We're going to go over the main cost types within a project that we see and or have risk of overcharges to you. So this is the meat of the GMP contract. So fee. The fee contract language should include a fee percentage calculated on the cost of work. The cost of work is what's required to do the work. And defining what exactly is the cost of work is critical. So typically we see that there's an article that defines each of the cost elements, which we'll go through today. And then it also includes a clause that says if it's not included within the allowable cost of work, then it's not allowable, or you cannot apply fee on it. So that's critical. We'll dig into that a little bit further later on in the presentation. And just another note for you guys, we often see like insurance bonds and other types of markups excluded from the fee calculation. So understanding and defining the cost basis is critical to not overpaying. We recently saw, for example, a fee clause that was calculated based off the total project sum. So the total project sum was the basis to calculate the fee, which resulted in a circular fee markup. So let's say that the project fee was 4.5%, but if it's applied on the total project sum, it's a circular reference. So it might not seem like a big deal, but if it's a $200 million job, which this one was close to that, this minor oversight can cost you hundreds of thousands or millions of dollars. General conditions. So costs include the cost to kind of run the project. Communications, computer equipment, meals and entertainment, relocation, safety, etc. I like contracts that have a matrix that clearly defines what's included as a GC, what's included in fee, and what's included in cost of work. Having clear expectations of what's in and what's out is critical to prevent indirect charges being charged to your job. Good contracts will include a clause that, and this is what I was talking about earlier, that will, if it's not clearly defined within that matrix, for example, it's not a part of the cost of work, so it's not allowable unless they get owner approval. So having the matrix and clearly defining what's in and what's out, absent owner approval, is critical. And I've seen these types of charges get very excessive. Like for entertainment, travel, moving, relocation. We recently had a job where they took the whole team, and the owner wasn't invited to a baseball game. and it was a substantial amount of money. So having clear expectations around these types of charges is critical so that you're not getting charged for it. Insurance and bonds. This is a common area where people get billed excessively. Having established rates for each of the common insurance products is critical. Everything's on the negotiation table. Whatever the rate is in the contract, you need to ensure that it's market competitive, doesn't include fee, and ensuring that you define the right cost basis for each. For example, or the common insurance products that we see are the general liability insurance, the subguard insurance, and the builder's risk. So, for example, this is an example we recently had where subguard insurance, it's a common insurance product for subcontractors on the job. We've seen where the subguard insurance rate was applied on the total cost of work, so all the cost versus enrolled subcontract values, creating hundreds of thousands of dollars of overcharges. You only need subguard insurance on enrolled subcontractors, not the other project costs. So unfortunately, the contract language didn't stipulate this, so a costly practice that could have been easily avoided by defining the appropriate cost basis and negotiating a market competitive rate up front would have easily mitigated this risk. Labor burden and related labor and related burden. This is one of my favorite areas to talk about. As discussed, labor is a common area of risk. The most common labor methodologies are actual cost and stipulated rates for salaried project management and hourly for craft or field labor. Each route, so whichever route you go, it carries a different risk profile. For example, if the rates are negotiated, are they market competitive? Is there an opportunity for the contractor to overcharge the job with labor rates to lock in additional fees? So if there's fee in the rates, if they overcharge the job with labor costs, they're getting more fee. So for actual rates, you need to ensure that you define what's in burden. So FICA, FUTA, SUTA, workers' comp are typically a given, but are you okay paying for 401k, health insurance, profit sharing, bonuses, housing allowances, cell phone, kids' tuitions, relocation? So people have different definitions of what's actual labor cost. The list goes on for the things that we've seen. We've seen a lot of creative things get passed through labor burden. So these types of things need to be defined as unallowable or allowable in any additions requiring owner approval. So I'll repeat that. So defining, if you go the actual cost route, defining what's an allowable, what actual means, and defining what's allowable and what's not allowable will save you a substantial amount of money and a lengthy negotiation potentially at the end. My preference is actual cost. As you know, if you know the true cost of each employee, they don't include profit. However, if you have stipulated rates, it can be practical as long as they're market competitive and don't include a lot of profit. Again, if there's no profit in labor, there's a higher likelihood that the labor charges to the job will be very efficient. That is, I find when contracts have no markup on labor, there's not really a benefit for the contractor to have more bodies on the job than they should. So the job's typically staffed perfectly. If the labor rates include a markup, a big one, there's benefit to the contractor to potentially overstaff the job. And some other areas to look out for: project management labor, and this is just a recent example that we came across, so wanted to share it with you guys. Project management labor is typically salaried, so limiting the hours worked to 40 hours can prevent front loading of hours on holiday weeks like Christmas or Thanksgiving. And so, for example, if the project management's 40 hours and their time cards show 15 hours Monday through Wednesday on Thanksgiving week, they get the credit for that, but you're paying for them to go on the holiday. So if they're salaried, limited to 40 hours, can help you save money. Labor burden rate should decrease for overtime and double time, such as FICA FUTA SUTA, because the caps have already been reached. And again, on-site, off-site definitions can prevent labor charges excessive labor charges to you. You want to make sure that you're not paying for people off-site at the corporate offices or while they're driving to the job. Subcontracts, one of the largest costs in the project typically. It accounts for 70 to 80% of the total contract. I think high level, my favorite thing that I love coming across with owners contractors is when they have an established subcontractor procurement process and procedures. That is, if it's a GMP, the subcontractors are the contractors are required to get bid documentation and provide minimum reports to the owner, and there's an established approval process. Having good procedures here can prevent excessive subcontracts and promote competitive bidding amongst a qualified pool of interested vendors. Most subcontractors are lump sum that require cost support for change orders. So the key here is when you get the change orders, really ask for detail. Get the itemized cost support and make sure that you're not paying for anything more than you need to be. Some subcontractors are contracted under GMP. So the contractor, and you need to check this, but the contractor needs to implement controls to ensure that the subcontractor is following the same terms as the primary contract, preferably. If not, you'll need to review the subcontractor language to go through the same exercise that we're talking about. You don't want gray areas. You don't want unfavorable contract terms. You want a good project at a fair price. If the contractor is performing self-perform work, you got to validate market competitiveness through well-documented bidding process. If they're doing the self-perform work, preferably they're doing it under GMP type conditions, not lump sum, so that you can quantify any overages. I'm seeing more and more fixed price self-perform contracts, which it really limits the owner's tools to prevent and identify excessive charges. That is, if the prime contract awards a subcontract themselves on a lump sum basis, there's concern, and there's not good documentation or procedures around this. There can be concerns about a lack of real bids, bid manipulation, cost shifting from the lump sum contract to the reimbursable portion of the contract, resulting in additional profit, which you didn't sign up for. So as a general rule, if the contractor is performing self-perform contract, push for the GMP type conditions as consistent with your prime contract. Rental equipment, another area of high risk, specifically contractor-owned rental equipment. However, third-party rentals can pose substantial risk if the rental charges are in excess of the cost to purchase the equipment. Equipment needs should be well understood, and cost-benefit analysis should be performed in the planning stages to ensure that you're not paying for someone else to purchase and keep the equipment asset. We recently had a job where we saw the purchase of the asset was charged to the owner, and then monthly charges were also charged to the owner. So that's not all right. Luckily, they had good contract terms, so we'll be able to get that out. Monthly rates should be stipulated not to exceed a percentage of a published rental rate or local prevailing rate. You should have caps on total rental payments as a percentage of the fair market value of that piece of equipment. You really need to make sure that minimum reporting standards are defined upfront. They should include items such as usage on the project, detailed equipment information such as model number, purchase price, purchase year, etc. Equipment charges should only be for equipment on site, and all equipment should be approved by you. Maybe the bigger items, you could probably apply the 80-20 rule to get most of the potential exposures out, but making sure that you have a good understanding of what equipment's on site and why it's needed and when it's needed. Rental charges should exclude maintenance. We often see that they'll charge you full market rate, and then you'll pay for let's say a transmission change on a truck. So that's duplicate in nature, so having good contract terms around this will prevent you from overcharges. In another area that we see often is computer and software charges that are directly charged to the project. So if someone's charging their financial operating system to the project, that sounds pretty indirect to me. So if you have good contract language, you can make sure that you have a very defendable position to say, hey, this is not allowable. Or something that's indirect in nature could easily be classified as overhead and profit, which is typically within the cost of work definitions. And again, ask for detail. All costs should be fully supported and caused directly by your project. If it's an indirect piece of equipment, then it should really be covered within corporate overhead and fee. Change orders. The typical process includes a request for information, a change order request, and then the change order. Supporting documentation is required to ensure that you're not getting overcharged. This goes for both increases and decreases. Contract language should set minimum reporting standards to prevent any potential excessive contract values. And then this is key, understanding the scope of the change is critical. You need to know if you guys initiated the change or if this is another issue that may not be your cost. Change orders should be approved by the owner, the architect, and the general contractor. And a common thing that we see is be on the lookout for general condition charges if the schedule hasn't changed. So let's say the project was going to take a year, there's no change to the schedule, and they do a change order and they include a project management cost to it. That person was already fully booked for that year, so you could say that it's already included within the original budget, not allowable. Also be on the lookout for errors or damages and or compliant or excessive fee markups. A recent one we came across was subguard insurance on self-perform work. They included the subguard insurance markup on that change order piece. So the self-perform work was not enrolled in the subguarded program, so it was an excessive fee markup that was not allowable. And again, I like change orders that are itemized and contracts that limit profit percentages at the sub and sub-tier level. If you have subs and sub-tiers, there can be quite a few of them, so having a cap on the total sub profit with itemized detail can prevent excessive fee getting charged to you. The right to audit clause. Again, it's almost in all GMP contracts. I've seen it. If you want a virtual high five, or I'll get you a cup of coffee next time we cross paths. If you get the right to audit clause within lump sum contracts, which I've seen a couple times, it's great. Again, knowledge is power. If you know what's getting charged to the job, even if you don't have recovery options, if someone's pushing a change order to you, you can use the information to maybe reduce it or negotiate it off the table. You can review quality of materials, etc. So the right to audit clause is your friend. So and you may be sitting there, where should I start from this presentation? And I think reviewing your contract and making sure that you have it is a great starting point. Again, the right to audit clause can help you mitigate project and program risk. You got to know whether the costs that are getting billed to you are compliant with the contract terms, and then reviewing the project costs timely is critical. So what I find, and we'll go through timing of audits, but when you do review of the cost and you do it early on and you identify things that may not be compliant, having good discussions with your contractor is good for clarifications. It's easier to negotiate $50 for something that's not fully supported by the contract. It's a lot easier to negotiate $50 versus $50,000. So getting the right to audit clause, getting the cost, and validating contract compliance is critical. And then just a final note here is, if you have the right to audit clause, exercising your right before retention is paid is a great practice. Once you've paid the contractor, and let's say you do the right audit clause, you may not be able to get all the information that you want. There's less incentive. All right, this slide includes some project-specific risk and controls. This is a great recap of the project cost risk and the controls you can apply. In the risk column, we have provided common issues we come across within our audits. The control side are some common things you can do to mitigate the risk. For example, labor charges, have detailed timekeeping documentation of all the contractor hours and making sure that it's all well documented. For change orders, you can make sure that you have all the approvals and make sure that there's no errors within the change order cost and that it's all itemized. So again, look through this list, jot down your questions and concerns for your specific project, and I'll try to get to as many as I can by the end of this presentation. If not, I'll shoot you an email and we can have a cup of coffee and talk about it. So great, there's a great list. You'll have access to the PDF afterwards, and you can put this in your office and go over it every day. And this is another one that I think is great. I love this slide. I often, when someone's got a project, whether it's planned, under construction, or during the closeout, they say, what should I be focusing on? So it all depends on your project status. So you're either in planning, programming, design, construction, or completion. The sub-tier language of these areas are the focus areas or the discussion items you should be having with your team. And I'm a believer that it's never too early to start planning to make a plan. So if you got projects coming up, I find the more time and efforts invested up front on the plan of attack, the more efficient and effective the projects are going to be. So planning and programming phases are critical. So I'll just take an example to highlight this. Let's say that you got a project that's about to go into design. Making sure that you have the best procurement practices in place are critical. So once you've signed the contract and all the sub-selections have been made, it's kind of too late to go backwards. So making sure that you go through these items and use it as a to-do list, your to-do list, to-do checklist, and having good procurement processes defined up front is critical to prevent overcharges. That one. All right. And then we'll go over a recent case study that we had. And before we get into this, the case study is good, but I think the bigger picture item is the construction audit is not a gotcha report. The goal of the audit, and this should be applied for external and internal people, it's not in anyone's best interest if you're going in there to say, hey, you did this wrong, and like, here's the write-up. The goal of these projects are to identify gray areas or non-compliant charges and develop a strategy with your team to ensure that you're not paying more than you should. It's in everyone's best interest to maintain healthy relationships internally and externally. So I find having good relationships, having frank and factual discussions with the key parties is the best case scenario for the best result. So we'll go over a recent case study. It was a $120 million expansion in the West, had 2 GMP subcontracts. We were engaged for the midpoint and closeout audits. Here we work very closely with the project and facilities management. It's a common belief that those people, the project management team, don't like us because they should be doing it, but we find that most project and facilities management are focused on the overall budget, project delivery, and they're not going through the granular level of detail that a auditor may do. So we were, on this project, we're able to identify near $33 million of non-compliant charges. A lot of it was due to labor charges where they had tier labor rates for each fiscal year. And when we got the cost back up, they were using the latest year and retroactively applied the rate, so it was a pretty easy analysis to come up with the 500K. We also identified a lot of related party equipment and job supply vendors that didn't have good cost documentation. So, like, if they have a related party equipment and they're only generating a internally generated invoice, that's not really proving actual cost. So the goal is to identify these gray areas, quantify them, use the information, as much information that's readily available and good source documentation to come up with a strategy so that you're not paying more than you should be. Guidelines for program and construction, project controls, assessments, and audits. And we got a polling question. Emily?
All right. Our third polling question, do you perform program and or project audits and assessments? And your options are yes, no, infrequently, or not applicable. And for those of you that would like a copy of today's slide deck, you can download those now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everybody a couple more seconds here. And let's go ahead and take a look at the results. Steve, back to you.
All right, let's see what we got. Okay, well, there you go. So it's pretty evenly split. Some of those you don't, it's NA, so if you don't know, maybe you could ask someone and they can let you know. But, yeah. Okay, so assessments and audits. As noted on the slide, it's pretty straightforward. If you do these assessments and audits, you can expect some good results, which will be noted on the next slide. When you can perform these, and someone just asked the question on the Q&A, you can really get engaged to these audits at any time. Again, the earlier, obviously, is the better. There's less for the construction auditor to do in the beginning, but making sure that you're hitting those key milestones and getting the process procedures established up front is critical. My favorite audit, it used to be the closeout audit because those typically have the higher values unless we're doing the initial audit. But the initial audit has been one of my favorites recently because the goal is to identify the gray areas, non-compliant charges, and having good discussions with all parties to get it cleared up. These audits typically cover operations and project delivery, the cost charges and controls. So if there's practices that are happening that are excessive or non-compliant, getting the controls in place to stop it. And the benefits from performing the audit, you'll see these in certain organizations, they value some more than others, but it's control improvements, cost recoveries, and stakeholder visibility. And these are the anticipated program assessment and audit results. Again, you get good cost controls, early detection of problems. You can validate that you have compliance with the contract terms. If you have internal controls or project controls, any issues can be identified and you can tighten up the controls. That if you have a lot of projects going on, you can do it across the board, which is great. You can reduce overcharges, improve communication, which I think is a big one. I think it's one of the biggest areas that I see is that you have the facilities department and the county department and senior management, and they all are siloed. So I think one of the things I really push for is getting all those stakeholders involved and promoting healthy conversations is critical. And then just an evolution towards a culture of continuous improvement. So yeah, it may be an audit if it's internal or external, but the goal is how can we get better? How can we tighten up our controls? How can we reduce costs for our organization so we can spend the money on other things? It's really protecting your stakeholders' money. and the expected savings from utilizing a construction cost auditor. And we have our fourth and final polling questions. Emily?
All right, our last polling question. Have your audits and assessments resulted in significant cost savings and or performance and control improvements? And your options are yes, no, undetermined, or not applicable. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. And a couple more seconds. And let's go ahead and take a look at the results. Steve, back to you.
Okay, we got undetermined and you're not sure. So if you have used the construction auditor, you should look for their end product and see if you have any savings or opportunities for savings. And these are some of our program and project audit successes. We have the benefit that we do these jobs on some really big programs, so it's easy. If you have a $1 billion program and you find 1% or 2%, it can really add up. So for some of the smaller projects that your program may have, they may be smaller, but again, any money that you can claw back or tighten your controls is a win. And then next steps, if you guys have a new program or project utilizing advisory support, whether it's a CPA firm or a trusted advisor that you trust that can walk you through this process to help support favorable pricing and contract controls. If you have a construction program in process, do a risk assessment on the program and figure out where your risks are. It's really easy to, if you have one project, look into the contract language and identifying if you have exposures. For example, I keep picking on labor, but let's just use that as a good example. If you have a project in process, go to if you have a GMP contract, go to the labor rate cost of work section and see what it says, and then look at the cost backup and see if you can support what's getting submitted to you, and if it's compliant with the contract terms. It's pretty easy and pretty straightforward. Assessing the staffing controls you have in place. Again, if everyone looks stressed out in facilities, then there might be an issue to look into. Maybe you need some more staff. If you overstaff, you might be paying for it on the back end in terms of having too much cost to your total program, which will bite you at the end of the program if you run out of money. So really understanding who's on your team, their experience level, what they're doing, what they should be doing, can help support a successful program. And again, conducting a detailed assessment of expenditures for contract compliance. It's not rocket science. You go to the contract terms. Every project can have a very unique contract term, so go to the contract, ask for the detail, and see how it's compliant with the contract terms. Every cost should match up with the cost of work section. So it's a fun and easy exercise. You may need 3 cups of coffee, but anyone can do it. And with that, I think we are on to the questions section. And we have 2 minutes to spare. So if you have questions, write them down. If we don't get to you today, then I'll shoot you an email, and if you want to discuss further, happy to do so.
All right. We do have just about a minute for questions, so we'll see what we can get through. If you have questions for Mark or Steve, you can enter those now in the Q&A box, or you may reach out to them directly. Let's see here. For fee billed or GMP, we usually get a bid up front. Are cost savings generally split between the owner and builder, or savings completely passed to the owner?
Emily, can you please repeat that question? My speakerphone kind of, can you just repeat it one more time?
Sure thing. For fee billed or GMP, we usually get a bid up front. Are cost savings generally split between the owner and builder, or savings completely passed to owner?
Got it. That's a great question. So everything is negotiable. So we've seen both. There is incentive. If you split the savings, there is incentive for the contractor to stay under budget. If you want to take the whole savings, it's completely in your right to negotiate it. There's pros and cons to each, so it depends on what you're trying to achieve. So the answer is both, and it depends.
Great, thank you. We are at the top of the hour, so if you have any questions we didn't get to, as Steve mentioned, we will do our best to follow up with you after the webcast. And thank you, Steve, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.